Let's take a look at the broader markets as we close out the final 2 trading days of the year. Joining us is Troy Gayeski, Chief Market Strategist and a Managing Director at Future Standard. Thank you for being here, Troy. So you actually think investors should be allocating more to the private markets, but they are more expensive. There are higher fees, and a typical 60-40 portfolio is looking on pace to notch a 15% return, which is double the average from 2005 to 2024. So what do investors really get from allocating more to privates?
Yeah, so that's our core focus: private markets, private equity, as well as private credit and private real estate. And when you look at the big picture here, Leslie, and you look at public markets, public markets, particularly the Russell 2000, trade at very elevated multiples, roughly 19 times EV to EBITDA. In middle market private equity, it's roughly 11 times. Plus, you get much better growth. The core thesis for middle market private equity is growth at a reasonable price. You're getting 1.5 to 2.5 times nominal GDP revenue growth, and you're buying that at a roughly 60 to 80% discount to the Russell 2000. So we're not claiming that these asset classes are perfect. We're very confident we can at least compete with the S&P and the NASDAQ over time through a full market cycle, and do that with much less volatility, much less drawdown risk, and provide true diversification. Whereas on the bond side, it's been very hard to make meaningful returns for approximately 5 years now.
Now, why middle market in particular? Is it a kind of a second derivative play on what you're expecting in terms of the rate environment, the macro picture, or just essentially diversification?
Yeah, the big key with the middle market is it's one of the true growth engines of the U.S. economy. There's approximately 200,000 companies. Again, the asset class as a whole grows revenue 1.5 to 2.5 times nominal GDP growth, which is a very impressive number. So you have this vast opportunity. You've had all this wealth created over time, but it's been very difficult to access for investors until the rise of evergreen private equity. So vast asset class, tremendous growth, great way to get diversification and exposure to what I refer to as like boring is beautiful, right? In the broader market, let's face it, so much of the outcome is going to be tied to whether there's an AI ROIC or not. So it's nice to be able to invest in companies like HVAC, paving, specialty foods, where you can get very attractive growth, not hyperscaler growth, but let's call it 10, 15% revenue growth, and you're getting in at a very reasonable price. So that's a key part of generating that risk-adjusted return.
Troy is like a rocket surgeon, as you know, chemical engineering, MIT.
Yes, thank you, Joe.
You know too much to be good at this?
Well, that's a very kind thing to bring up. I really enjoyed the engineering background, but it's fascinating, the market opportunities.
I'm leading into, so you have developed a thesis on how to explain the strength in nominal GDP and the strength in the labor markets. Is that true?
I don't know about any broader white papers or theses, but one of our core theses the past several years is that we're going to continue to have very strong nominal GDP growth.
Why?
Right. Well, because real GDP, as you know, is running very hot. Strong consumer, not as strong as 2 years ago, but still very strong. You have a situation where in the greatest business fixed investment boom of our lifetimes, tied to AI, but also broadening out. And all the drag that we thought we'd have from government spending is not playing out. So real GDP next year, roughly 2.5%, 3%. Then you put on another 2 to 2.5% at least on top of that from inflation, and that's what drives the strong nominal GDP growth. And the thing about that people always forget is nominal GDP drives revenue, whether it's for large cap listed companies or whether it's for middle market private equity or middle market private credit. It's nominal GDP that's important. Anytime you're long an asset that has economic risk, you want as strong a nominal GDP growth as possible without 9% CPI, of course.